Okay, thanks everybody. I've just had some feedback that you can actually see me, but I'm normally I can see myself when I'm talking, but that's right. I don't need to see myself, and you can hear me, so that is great. So I'm going to get straight into it. So we've been doing webinars for the last few weeks since we went into lockdown, and it's been very interesting. It's been very useful for people, and we've been asked to do more. So tonight is one of those, but we're actually going to start now talking back to the market, because the good news is next week we are in one of the very few industries that is able to get back and do some transacting. So we can talk about tonight about when we emerge from COVID-19 into level 3 and what the market looks like. And secondly, what we could do to help you. I'm going to then talk about property finance for property investors and first-home buyers. I'm also going to then talk about cash flow and why it's so important. I call that 202, Finance 101, Cash Flow 202, and then we're going to do Property 303. I'm then going to dive down into the banks, numbers, how you purchase, and the long-term way to make it work. And it seems simple for us, but we get asked the same questions all the time, so we thought we'd bring that topic up. Interest rate management is probably something we don't talk enough about, and I think we will probably talk about that more frequently over the next few weeks and months, because it's so important, especially in an environment where we've got historically low interest rates, and how you as a property investor can create borrowing power in an unlimited way, and how you deal with tax. So we're not going to talk about regions. We're not going to talk about, if you've been on these webinars for the last few weeks, we're not going to talk about regions. We're not going to talk about COVID-19. I think we've done that to death. We're going to get into the sort of more matter-of-fact and practical stuff, including best practice investing for property investors. So who am I? What am I talking about? Well, really quickly, I've been doing property since some of you were born. And I've been 27 years in the industry. I've been a renovator. I've been a trader, an investor. I'm still an investor and a trader. I had 3 years of developing, and I wouldn't wish that on anybody. It's hard, it's expensive, and it's stressful. It can be very profitable if you get it right. And we did get it right, and we also got it wrong, and we learned a lot. But it also gave me the reality check that, developing is not for everybody. And I have been developing over the last couple of years, but on a much smaller scale than we did back in the 90s. I've also been an investment lender, and I've also been involved in real estate agency for over 7 years now. So I'm currently involved in agency work. I'm a trader and I'm an investor. And I guess some people call me the property guy, because I've pretty much touched on every aspect of property apart from hammers and nails. I did that for a weekend and worked out I wasn't very good at it. So I decided that, no, I'm not going to be a builder. So, yeah, I've pretty much touched everything. 10 years as a property manager for my own properties. Again, I wouldn't do it again, but I learned a lot in those years. So I try and pass on my knowledge from what I've learned through to our customers, because at the end of the day, property can change people's lives significantly. And from if you do it right, you don't have to spend 20, 30 years doing it. You only have to spend 5 to 10 years. So that's me, who's the Property Factory. Well, Property Factory started with me doing a sort of quasi-MBA, and I wanted to solve a problem. And the problem that I was trying to solve was, we've got all of these real estate agents in the country, in New Zealand, about 15,000 of them, or thereabouts. And we had a housing shortage of 50,000 at the time. This was right back when we'd been off the back of the global financial crisis. There was no construction. So we had this massive housing shortage. Yet I had more listings, more developers, more vendors, more owners of property that wanted to sell property than we had buyers. And it didn't make sense to me. So my problem that I wanted to solve with the Property Factory was to be a bulk sales business. And I guess that is great for developers and builders and vendors, because all I wanted to do was match great property with perfect investors or perfect first-home buyers. So we've done that, and we've been doing that for a while now, and we have a members-only business where We're not on TradeMe. We're not on realestate.co.nz. We're not at Harcourts. We're not at Ray White. We're not at Bailey's. We are a business that works directly in what we call the wholesale market for property investors, first-home buyers. So in the last 24 years, we've sourced and sold over 2,000 properties. I mean, we haven't updated that number for over a year, so probably 2,500 now. But I guess we've been doing what we've been doing for a very long time. And I think once you do that, you get good judgment and you get good gut feel and you get good wisdom for other people to benefit from. So hopefully tonight we can do that for you. If I look at our team, we have over 50 years combined experience across our team now. We've got a national team. We've got people right across the country. So we have a deep level of experience and knowledge across all of our people, not just me. So just checking. I'm just going to check that people can hear me. If people can just say yes or no on the chat. And you've got a Q&A box and you've got a chat box. Just want to make sure you can hear me. And thanks, Max. And that you can see me. Not that it really matters if you can see me or not. Okay, cool. Got all the yeses. So we are only in day 29 of this lockdown. Now, for the last few weeks, we've been talking about the coronavirus and COVID-19 and the way it could affect us. I feel like for our business or our industry, and not our business, our industry, we're at the other end of it. It's not all over. We've got a long time with this being around us. But from a property point of view, we've been talking about how it's affecting us versus other industries. And we're only in day 29. I mean, it's not even a month yet, but it feels like day 290. And I think that's more social, more humanistic, more interpersonal. People are just dying to get back out. And, you know, we're early days. I mean, other countries are into month 3, so month 4. And it's interesting how the world's changing around us in terms of how everyone's operating. But yeah, we're still actually early days, and we're about to come out of level 4 into level 3. So it has been rated or listed as the largest crisis since the war. And I guess in our space, is this another GFC? GFC standing for Global Financial Crisis. And the reason that's relevant, you know, I'm not going to talk about the 1987 stock market crash. I'm going to talk about the GFC because we were first in the queue to be affected. We were tourism in this crisis. So is this another global financial crisis for property? Let's just look at that for a second. So fundamentally, we still have a housing shortage. That hasn't changed in a month. We've got the lowest interest rates in our history. And I look at our product. What are we selling? What are we helping people get? What are people buying? What are they ending up with? It's an investment property, or 5 or 10. And it's a long-term product. It's a low-risk investment. We're not selling shares. We're not selling Airbnb. We promote long-term, low-risk investment property with 12-month, 24-month leases. Not commercial real estate, not retail. We're residential property, and it's at the lowest risk spectrum of the real estate industry. In simple terms, and I'm going to break this down tonight, rent less costs equal profit. That's it. If you rent, there's more than all of your costs, you're making a profit, and that's like business 101. And fundamentally, there's 250,000 small businesses in New Zealand, and a lot of them fail. And the great thing about property, anyone can get into it, and it's a business, and it is simple as rent less costs equals profit. And that's at a simple level, and I'll break that down later, but that's as simple as this business needs to be. Now, with this COVID-19, the biggest risk in our space isn't liquidity, which was the global financial crisis's problem. There's a lot of money out there, huge amount. The biggest risk is unemployment. If New Zealand has 30% unemployment, we will be affected. But I believe if New Zealand has less than 10% unemployment, like some commentators are suggesting, because of the way our government has functioned in this crisis, and that our industry is going to be very, very non-affected. And we'll talk about that as I go on. So we're going to be watching this like a hawk. But at the moment, we've got a government that's paying people, it's paying employees, it's paying self-employed people. Now, can they do that forever? No. Can Can they do it for a short time? Yes, because our government had very, very solid financials before this crisis occurred. So we're in a situation where we actually can pay people. We have got a country that's flush in cash. Secondly, we've been talking to a lot of people during lockdown because it gets pretty lonely on your own, from developers and vendors and builders to investors to our partners like property managers and financiers, mortgage brokers, accountants, lawyers, blah, blah, blah. We've been talking to everyone, and the mood that we're getting is confidence across the board. And I'm not holding my breath just yet. It's only day 29. But if I do a risk analysis or profile of our whole spectrum, it's really only unemployment that can have a massive impact on us. We're not in the tourism market. We're not in the Airbnb market. And even then, people from Auckland are still going to come to Christchurch, and people from Christchurch are still going to go to Auckland who don't want to spend money in a hotel. They want to go into Airbnb. So it's only places like Queenstown and Wanaka and Waiheke Island and Rotorua that I think the Airbnb market could be massively affected, because that's where the main tourists go, into those tourism spots. So there will be a change, but it's a long-term gain. And a game, not game, I should say game. There's no need to sit on your hands. This is not the GFC. Banks are still lending. Properties are still good deals. And none of our developers or vendors or builders are going to be dropping price anytime soon. They don't need to. 4 weeks, 8 weeks, 12 weeks in the world of a developer is nothing. I mean, these people plan to take 2 years to get a project out of the ground. So this isn't a GFC, and the deals that are on that will be on the table, and there will be deals. There's no question there'll be deals, but they're probably not great deals from a property investing point of view. If you're buying a house, sure, but if a builder is exiting a property, it might not have been a good property in the first place. So one of the things we do is make sure that we only list and promote first A-grade stock. And the other thing is, we have changed as an industry. Our real estate agency is 100% digital. We can do everything digitally, and excitingly this week, we can now do digital signatures on contracts. So that came in a couple of weeks ago, but we haven't actually launched it yet. So if you do a deal with us, you can do it all from your home, and we'll show you how to do that. So we're 100% digital. So no, I don't think it's another GFC, and neither do people that I work with, I associate with, that I take advice from, that I listen to, that I work with on a consulting basis. We think that this crisis is different for property, and that it will become business as usual in the world of property investing. So how can we help you? Well, as I said, we're digital, and we can help you buy in isolation. Our industry has been granted permission by the government next week to transact. And our valuers, property managers, building inspectors, all the people that you need to get involved with, or if you haven't done it before, you will be involved with during what's called the due diligence process, are all available as of next week. So our industry is so looking forward to getting back to work, and everyone I speak to is excited about still being careful, still being safe, practicing social distancing and all the rest of it, but getting back to work, because it's pretty boring at home all day. So how we can help you is typically during the due diligence process. I mean, all of our deals you can see online, but if you get into a deal, well, you might need fresh photos. You might want a new drone video. You might want a video on site. So we can do all of that in Auckland, Hamilton, Wellington, and Christchurch for you. And we've got people in all those locations, and we can help you out. And in doing that in itself, you'll learn a lot about buying property and becoming a good investor. And if you've done it before, you'll know it's all done. You can do that. So for the first timers, it is real. For the second, third, and fourth timers, it's just normal. Apart from you can now sign digitally, or in the past you haven't been able to. All of our financiers are processing loans, and the feedback there is they are not. If you're going to a new bank, if the broker is taking you to a new bank, you cannot get a loan application in without an actual contract. So the news there is that we will be encouraging people to go into conditional contracts, what we call a parachute clause that you can pull and cancel at any point, but you will not be able to get a loan approval in this climate unless you've got a contract in place. That's what all of our brokers are saying. So all of our team will be encouraging you to get into conditional contracts that we will do for you, and then you can do your due diligence. And that's actually the better way to do it anyway. We've been encouraging that for years, but not everyone's been doing it. But now you have to do it if you want to even do any kind of due diligence on a real deal. So for us and our vendors, it's all business as usual with a few rule variations around open homes and going through property. So, and finance is such a key topic, hence why I'm going to talk about it tonight. 95% of investors, pretty much 100% of first home buyers will need finance. They need, and let's look at the terminology for finance. Debt, gearing, finance, funding, lending, money. It's money that you're going to borrow off the bank to help you buy a rental property or your home. Your bank will lend you money, but they won't. And this is where, if we look at finance, in the world of property investing, we do not recommend you go to a bank. We recommend that you go to a broker, because your bank won't play one bank off against another. They won't split your lending across multiple banks. And we launched a new product this week called debt plans. We're going to keep our customers debt plans. And if you haven't got one, we will provide you with one. And that's how to do finance properly. And no bank in New Zealand does a debt plan for a client, because debt plans involve multiple banks, and we are spreading your risk across those banks. Whereas most banks want all of your business. Well, sorry, every bank will want you to stick with them for everything. But as an investor, that doesn't work. Your banker will not look at your lending from a tax, asset protection, or risk management perspective. And they won't help you decide if the deal actually makes sense for you or not. They'll say yes or no, but they won't tell you that it's a good investment decision. Whereas an investment broker, or an expert investment broker, not your mate, the mortgage broker, but somebody that specializes in investment lending, what they will do for you is help you over the long term. They want you to come back. They want you to be a repeat customer. They'll be a key person on your team. I learned more from my broker in my early investing years than any other advisor, any other team member, any other partner, any other helper in property. My broker, who I ended up working for because I wanted to know more, he was the number one person on my team. And we have great brokers around the country. And if you've got a mate that's a mortgage broker, steer clear. They're not created equal, because most brokers are doing mum and dad home loans. Investment lending is very different. And we've probably been a bit soft on that, and it's bitten us in the ass because clients have been frustrated they haven't got finance sorted, and we've let them, or said, yeah, go to your normal broker. But then we've looked at the broker, and nice people, great for a home loan, but not for an investment loan. So we're going to get quite tough on that with our clients. And it's not about your friends and supporting your mates. We all like to do that. It's actually about using the specialists. And these guys and girls they'll just give you knowledge that you can't get from a bank, because it's all about the numbers with investment lending. And we've had some cases recently which has sort of made us talk about this a bit more. They do become an objective advisor for you. They don't get paid unless you transact. So they're doing all this work at the front, not on the hope that you work with them, on the fact that they know they can help you. But I think some of our investment brokers get probably abused a little bit, and so we're going to actually start qualifying clients for them to ensure that they don't just waste our brokers' time, because they've only got so many hours in the day and the week, and not all brokers are created equal. So our expert investment brokers are going to be an absolute goldmine for you moving forward. Just have a quick look at, I've got some questions here, but I've got David answering those. Okay, no, he's doing that now, so he doesn't need me, and nothing in the Q&As. Okay, let's grab a drink of water. So finance is critical, and it's more critical than the topic to make sure you're dealing with someone that knows what they're doing. And if you're a first timer, you probably don't know who that is. And that's where we will make sure that you've got the right broker. If you want to deal with your bank directly, sure, but we'll be pretty cynical in terms of setting things up properly, and probably tell you not to do it. the money could still go to the same bank, come from the same bank, because your broker can deal with your bank that you're dealing with now. But this is just about building your team. So please take our team's advice on that. Okay, cash flow 101. On the right-hand side of your screen, you will see a snapshot from our website. And if you won't see that unless you're a member. So and membership's free. So once you log in, give us your details, sign in as a member, you'll see the wholesale members dashboard, current projects, investment capacity report, property matching report. But when you look at our current projects, you will see a whole lot of downloadable information. And one of those things is a cash flow. And if you're not a numbers person, you need to find someone, and our team can help you with that. But the reality is someone on your team needs to understand the numbers, because property is all about the numbers. It's not about the colour of the fence or the colour of the roof. It's not about bragging rights that you own a property in Queenstown. It's all about the numbers. So find yourself a numbers person. Now, cash flow 101 is as simple as rent less costs equals a positive cash flow property or a negative cash flow property. That's as simple as it is. $400 a week in rent less $350 a week in costs equals $50 of positive cash flow. Doesn't sound like much. You times that over multiple properties, over multiple weeks, over multiple years, and all of a sudden you are flying around the world off rent. So if 400 is greater than 350, it's a positive cash flow property. But if it's $400 a week in rent and $450 a week in costs, it's a negative cash flow property. It's still a property and it's still got cash flow, but it's negative. You are paying $50 a week to keep that property going out of your personal income. And I know this sounds simple for our existing investors, but we actually have realized that a lot of people just don't get the numbers. So if you're a first-time investor, you should not buy negative cash flow properties. Okay, you should buy positive cash flow properties from day one. And as simple as that sounds, it's scary how many people get it wrong. So at the most simple level, if the rent's 400 and you work out your costs of 450, don't buy it. Okay, if your rent's 400 and your costs are 350, that might make sense to buy. Go to the next stage. And the people that buy one property and never buy another property are the ones that buy the 400 and 450 of costs. And eventually what happens is they run out of borrowing power and the bank says no. So, long term, it's about cash flow and capital growth. And that's where it gets a little bit more complicated, because people, if they haven't bought a property before, the only measure of capital growth is in their home. And yes, it's a property, but it's a home. It's not an investment property. So the real money in property is in the long term, and it's in the capital growth. But you can't get there without cash flow. And it's just, I don't know how many ways I've said this to different people over the years, but cash flow is king, even though you make your wealth from capital growth. In the engine analogy, cash flow is the oil, capital growth is the horsepower. And that's what gets you from Christchurch to Queenstown, but you can't get there without oil. So cash flow and capital growth are so important. Cash flow first, capital growth second. So the mistake of getting it wrong is way riskier than just basic property 101. And it's amazing how many people do get it wrong. And we've had some hard discussions with clients. We've had some real discussions with clients saying you should sell property A, B, and C. Oh, I don't want to. I've owned them for a long time. We said, yes, but you're propping them up from your personal income. That is not good property investing. So let's look at how this looks in a real life example. So this is a property where someone's paid $330,000, and this is stuff you can download off our website. So let's just look at the boring numbers, the hideous accounting, the dollars and cents and the lines in a spreadsheet. Now, for some people, that chart there will be really boring and might not make any sense. So I'm going to take you through it, and I'm going to explain it in as simple a term as possible, because not everyone's numbers focus, and we accept that and respect that. So this is what's called a forecast, a cash flow forecast. There are lots of different cash flow forecast spreadsheets or downloads you can get off the internet. This is our cash flow forecast. We use our assumptions, and I'm not going to chop it up too much because our team can help you do that. But this is a 10-year property investment cash flow and growth forecast. So this measures cash flow and capital growth. This property is worth $330,000. Its rent on entry for year one is $410 a week, and its cash flow before tax per annum is $5,742, and it's $110 a week. Doesn't sound like much. Now that's after year one. So your rent's less cost is positive by $5,742. Great. Now you're not going to Europe first class for the family on that. This is year one. This is one property. Times that by 5 properties, times that by 10 years, and all of a sudden you're dealing with serious money. And that's just the cash, not the capital growth. So that's year one. And all of our reports go through 10 years. There's year 5. You can see that the combined cash flow, the cash flow at this point is now 7,346. That's before tax. That's assuming that rent's gone up, costs have had increases, CPI. So we use a whole lot of assumptions that you can see. So that's year 5, and then that's year 10. So we always do it as of today, 3 years, 5 years, 7 year, 10 years. So that's an unfurnished rental property with a forecast cash flow with the information that we know. Then we get down to the nitty gritty of what about capital growth? So that was cash flow, this is capital growth. And we put a whole lot of assumptions in. New Zealand's long-term capital growth rate is about 7%. We use 6% because we want to underestimate versus overestimate. So all of our modelling, we use 6% as the national capital growth rate. So forget all the other numbers on this sheet, apart from the net cash flow before tax plus capital growth line. So after year one, that's 27,000. So that's assuming capital growth of the property, which is 330, and it's the net cash flow increase. Year 3, 30,000. Year 5, 34,000. Year 7, 39,000, and year 10, 47,000. Now that's cash flow per annum. So if you compound that over 10 years, your equity in this property, your wealth has gone to 287,000 over 10 years, which sounds crazy for a lot of people because they haven't seen it or experienced it. But as property goes up over time, if we go back, we're saying that this property after 10 years is going to go from 330,000 when you buy it. Year 1, 350,000. Year 3, 398,000. Year 5, 452. Year 7, 512. Year 10, 619. I've been in 4 cycles where I've seen this growth. Okay, I've got properties in Wellington that we can show actually higher growth in this in less than 10 years. So we use assumptions that we expect to happen, but it doesn't always happen every year. Sometimes you get growth and accelerated growth in 3-year spurts. But long term, over New Zealand's property career, properties performed at about 7%, and we use 6% as the capital growth amount. So that's where you get your wealth from. That's how people have bought fast cars and great holidays off gains in property, or where smart property investors have taken those gains and put it back into property. So a property that's gone from 330,000 to 619,000 has funded itself the whole way through. That customer has made $287,000 over 10 years, which sounds about right. But when people see the big numbers, they go, well, that sounds too good to be true. But it's one of the reasons why property has always been seen as such a secure and long-term asset. So we don't typically break these down. It's the first time I've done this. And a lot of customers find these cash flows daunting and confusing. No problem. Our team will talk you through them. So please call one of our team or email one of our team, and they'll talk you through for any questions. There's no such thing as a stupid question. So cash flow and capital growth 101. That's how we show it. That's how we measure it. And that's why property is something that makes people wealthy. So that's property 101, cash flow, capital growth. Property 202 is where, which one do I need? When do I need it? And it's all about timing. So if you look at my little picture there's 3 silver balls for the gold ball. So let's assume that's equal. Those 3 balls are worth the same amount as the gold ball, but they're stronger in cash flow versus capital growth. So we use the gold as the gold mine for the capital growth property, or the capital growth from the cash flow properties over time. But it's important that you've got 3, not 3 to 1, but more cash flow than capital growth. And if you do that, if you follow that simple rule, your portfolio actually becomes self-funding. If you're propping up your property portfolio, that's not a good thing. Okay, I am not propping up our rentals. They are completely self-funding. And if you're not sticking to that mandate, you're going to come into trouble. And the great news is, I'm 51 years old, and I bought my first property in my 20s. And it was really hard to find cash flow positive property that didn't cost a lot to run. We are currently providing and sourcing cash flow positive properties that are brand new in Auckland, Hamilton, and Christchurch. It's unheard of in my property career. So we're living in a property. It's a property storm of epic proportions, in that you can borrow 100%, up to $5,000 per annum, positive cash flow in a product which is very early in its life cycle, and that gives us comfort that we're expecting capital growth from a lot of the properties that have come out from the demand exceeding supply, the Auckland Unitary Plan, the special housing area, the change in New Zealand's demographic of houses going to townhouses, going to apartments. There's a lot of things that have changed in the last 10 years in New Zealand, and we are back to an environment where you can buy positive cash flow property, brand new, double glazed, in good locations or great locations. And I'm still seeing old school investors going for second-hand, single glazed, crappy old properties that should be bold and have new ones built where they are. So we're going through a real paradigm shift in New Zealand at the moment, and we are absolutely pro 100% new. Okay, property 303. Think your third year at university. It's a bit more complicated, a little bit harder to get. And that's where the property clock and the property cycle meet. And I'm not going to go into this tonight because we wanted to talk about cash flow and a few other things. But property cycles and property clocks are real, and it's basically measuring where is a property at in its property cycle. Where is it at on where's the market at on the property clock? And this is where you do need some people that know what they're doing. And our team can talk you through both of these things, because it is property 303. It is a little bit more complex. We normally talk about it at every presentation, but I'm not going to tonight because I'd spend 20, 30 minutes on it on its own. Just encourage, and we've got videos on this you can watch. But long-term low-risk investors diversify location and they diversify product being apartments, townhouses, and house and land packages. Because not every location goes up at the same time as each other. You want to buy at 6 or 7 and you want to reinvest or sell at 12, 11 o'clock. But it's scary how many people do the opposite. So I won't take questions on that now. Dave, you can ask questions on that and David will answer them. But the reality is, you better have a chat to one of our team, because they will literally take you through it for an hour if you want. So 101, 202, 303, that's as simple as property needs to be. And I guess as a business, because it is a business, it's amazing how many people don't do those basics. Okay, back to my little agenda. The bankers. We deal with bankers every day. Well, we don't. We deal with brokers, and our brokers deal with bankers every day. And they are an important part of being a successful investor, to the point that until we move to a new money supply, and I believe in my investing lifetime, we're going to be borrowing money through the internet. It's already happening in other countries. In New Zealand, it's not. Well, that's not true. No, you can borrow money through the internet at peer-to-peer lending level. But in terms of buying property, I believe I will be able to go online in not that many years and get a loan. And I believe I've got to push buttons and then buy a property with that loan, all online, without the plethora of people that currently work in our industry. So I think the whole thing will go digital one day. But I guess I'm a digital maniac, and I just love technology. Worked for Apple twice. I have a history of just everything I look at, I think, how can that be digitized? So I believe in our lifetime, we will see the whole banking industry go online to the point that finance is literally another click and point, and it'll happen easily. So bankers, let's talk about the bankers. Your standard banker is a salary plus a bonus, and the bonus comes on targets. So they're actually salespeople. I've got some good friends that are bankers, but if you're a lender in a bank, you are incentivized to lend money out. That's how the banks make money. There's no risk on them if you win or lose. And simple banking, go direct, go to your bank, go to ANZ, Westpac, National Bank, not National Bank. Go to BNZ, ANZ, Westpac. Go to any bank, SBS, doesn't matter. But when it comes to investment lending, you do not want to go to your banks direct. It's not a simple exercise, and I don't think I've met any bankers who haven't worked outside of the banking industry who really understand investment lending. And I guess when you're growing a substantial business, as your banker and advisor, for me, I see them as debt finders. They're not experts in advice around lending or structuring. But to be fair on people, who is your accountant, your lawyer, your insurance broker? Are they your advisors? And it's actually quite hard in the world of property investing to get advisors. So a lot of what we do is advisory based. We give people advice on what they should do. Talk to this broker. Here's a property lawyer, because not all lawyers are smart on property. So don't deal direct with the bank. It is just not smart investing rules. Because banks make a lot of money in interest, but not advisory fees. They're not an advisory group. They're bankers. They borrow money. They take money on and pay interest on that, and then they lend it out and charge interest on it. That's how they make their money. And also the banks are changing. We've now got the Bank of China, the Bank of India. There's a whole lot of new lenders coming into the market. And, every single time a bank lends you money, no matter how long you've been with them, they treat it like your first loan. When you get to about 1.5 million bucks worth of lending with any bank, they typically put the brakes on. So long term, if you want to be an investor, it's not going to work for you, because if you stick with your bank and your loyalty, which is typically a Kiwi thing to do, the brakes do go on. The good news is there's lots of banks, like these new ones. And I believe in the Northern Hemisphere, you can borrow money off Google, Amazon, Facebook. Peer-to-peer lending is in New Zealand, not at property level yet, but I believe it'll come. Syndicate lending. I think we're going to see a lot more lenders that came from left field that you didn't think of. I mean, when you buy a car, you'll be surprised at where the money's coming from. We borrow about 30% of our money in New Zealand offshore, and for different things. So in the world of goods, you'll be surprised at where the money is actually coming from that's paying for that you've borrowed to pay for something. So, banks are changing. They're worried because companies like Google and Amazon and Facebook have so much cash on hand. They've actually got their own banks within their businesses, and they're looking at creating liquidity to the point they can lend more. So they've got liquidity. They're looking at creating systems to allow them to be lenders. And the biggest problem will be governments, because governments they regulate lenders. So it's not just a case of Amazon deciding they're going to lend to us in New Zealand. They'll have to jump through a lot of regulatory hoops before they can do it. But it will happen. It's already happening overseas. So interest rate management. So don't go to the banks, use a broker. And when you've got your money, interest rate management is all about smarts around debt. And it should be called, I should have written that debt management. So we'll call it debt management. Now, brokers who know what they're doing. They're a long-term asset to your team, and they'll come up with views and strategies that will save you money in the long term. So they're a long-term partner. Now, you can do it yourself or pay someone, but we believe that, and there are companies out there, there's websites out there, there are books, there are people that'll give you financial advice if you want to pay for it. No problem, do that, because that's better than still going to your bank direct. But when it comes to finance and interest rate management and debt management, your broker is all you need to do. You're expert broker. Sometimes things will change. They get special offers. They get paid by the bank. You don't have to pay them. And here's just some basic rules about interest rate management and lending. Don't have all of your loans on fixed rates maturing at the same time. So if you have $5 million, it's not smart to have $5 million coming off a fixed term loan in one hit. We would recommend that to be split over 2 or 3 or maybe 4 loans at different times, some floating, some 2-year, some 4-year, some 5-year. We like to have about 10% of your debt in revolving credit or cash, so that you've got what's called liquidity, 10% of your total lending as a bit of a minimum measure. So if you've got 300 grand worth of debt, you should have $30,000 on hand. If you've got $3 million worth of debt, you should have 300K on hand. We like that 10% minimum. And one of the things which COVID-19 has really shown is how week to week or month to month Kiwis are. And I've been listening to a bit of commentary around this, and whether you're an investor or not, having funds for the unknown is very prudent. And when you're borrowing $1 million or $2 million, it's even more prudent. So that 10% is sort of just a typical rule of thumb, and it's a minimum. Bigger investors with $3, $4, $5, $6 million worth of debt will probably have more cash on hand than that, or available credit on hand. So that's just a typical rule of thumb. And as you consolidate, that's when you start looking at going back to less lenders, because once you hit $1.5 million with most banks, they typically put the brakes on. So if you get to $5, $6, $7, $8, $9, $10 million worth of debt, and we've got clients in that position, they can negotiate seriously low interest rates, way lower than Blackboard or website interest rates, but they can also negotiate longer fixed terms. We've got one client that's just negotiated a 10-year fixed loan in the 3s. So, but the debt was huge and the asset was huge. So lending at that point becomes a bit more complicated, to the point that it does actually make sense to go back to the bank. But you're not dealing with a retail banker on Willow Street or Lambton Quay or Queen Street. You're dealing with a sophisticated property finance expert who's been in the bank for a long time, and they will actually go and negotiate a tranche of debt on your behalf at wholesale rates. But, let's walk before we can run. So unlimited borrowing power. I know it sounds crazy, but you can buy property 100% funded, and with capital growth and cash flow, you can literally create unlimited borrowing power. Now, you'll go through some periods where it's tougher than others, but if your numbers play along the right growth path in terms of rent and capital growth and property acquisition, you can literally be in a position where you've got unlimited borrowing power. And we have these terms, equity rich and cash poor, and I'm talking about customers now. Most clients I see are equity rich and cash poor, and that limits their purchase options. Other clients are cash rich and equity poor. They should say equity poor, sorry, the typo there. And this limits your purchase options. So now you can't change this by overnight. So we are one of the companies that actually explain this to you in English, and rich and poor are strong words. Equity, strong, cash, weaker, but I like strong words. Most people are like this. They're one or the other. Every now and then we get someone that's perfectly in the middle, and that's your perfect investor, because what they've done, they've balanced their cash flow with capital growth equally. Now, it's not easy to do because you can't control the property market. You can't control capital growth rates. Sometimes you can't control your income if you lose your job or if you get a pay rise. So it's a constant thing you review. where are we at? Are we stronger in equity or stronger in cash flow? Where are we from a cash flow and an equity perspective? Always ask that question, because if you keep them balanced and if you grow at that rate, and to some extent that's the market and your income and your debt and everything and your expenses, you'll constantly have a base that you can grow from in terms of unlimited borrowing power. And as your portfolio gets bigger, it gets easier. But you should not relax your rules, especially, and this is I think a Kiwi thing, take Wellington from 2015 to the current day, huge equity growth. I spent 10 years of my life living there, and a lot of people I know there have spent that equity growth on stuff that doesn't bring an income. Not smart. Your rules shouldn't change no matter how big or small your portfolio is. And some of the large investors, now if they're slowing down and they're cashing up and putting their feet up and retiring off the income, different story. And that's when your expenses typically go down. But you should never live beyond your means. And as your income and equity keep growing, if this grows quicker than your income, don't spend it. Because your income is still here, but your equity's up here. Push this up. Go up, 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 up. Don't go up here and hope like hell that you can fund it. Because unless you're buying income producing assets, when you have equity growth, you should then focus on cash flow growth. Okay, it's all about getting that even balance. Repeat again, and then repeat again. It's that simple. And I like the analogy someone gave me the other day. Being a property investor is like being a pilot. You can't get lazy. Every flight you could die as a pilot, but also you also need someone else checking on you. Pilots have to do annual medicals. So we do annual reviews with our customers. We're here to keep you honest. We're here to help you find property, but we're also here to give you feedback. We are not someone that just will sell you anything. Our business matches property with customer, and we do it based on your cash flow rich or cash flow poor situation versus equity rich, equity poor situation. And we help you manage that understanding. And that's one of the things which I think really does set us aside from a lot of different companies out there. Well, there's not that many companies that do what we do anyway. So we help you not getting lazy. And when you choose to stop, right, no more investing, that's when you're literally saying, right, I'm going to live off my portfolio. And you'll live within the means of that portfolio, whether it's $1 million a year, $100,000 a year, or $50,000 a year. You will choose, with our help, where that point is. So, tax, how exciting. What a great topic. I'll just have a quick look if there's any questions pressing for me, but I'm sure David's answering them. Oh no, he's belting away on the keyboard. It's great having someone answering questions when you're doing these things. And I will do a Q&A later where I will answer some questions towards the end, which I'm nearly there. So let's talk about tax and tax efficiency. And again, New Zealand and Australia have got pretty similar tax rules. We're actually far more favourable for property investors than Australia, in terms of we don't have a capital gains tax and we don't have a stamp duty in New Zealand. So tax efficiency first of all, tax. If you're paying tax, you're making profit. I'll never forget when I was a 20-something-year-old, I was listening to this farmer talking to my father, he was a lawyer at the time, my dad was a lawyer at the time, and he was telling my dad that he didn't want to make a profit because he's got to pay tax. Now that's just, back in the time I was thinking, well, if you don't make a profit, you don't pay tax. What does that mean? I didn't know what profits and things meant. Now, if I was standing next to my father and the same farmer said that to him, I'd call the farmer a moron. I mean, if you're making profit and you're paying tax, it's a good thing. Where is that not a good thing? So what a wonderful business. We don't have capital gains. Our tax rates aren't out of control. Sure, they're not like Hong Kong's, but they're also not like France. We have a modest tax rate for companies and people in business in New Zealand. My same father, I've only got one, he left New Zealand when the top tax rate was 66%. 66% tax. And that almost incentivizes you to work less. And that's where France is very much like that, very high tax rates at the top end. Whereas we've got in New Zealand a tax system in our topic, our sector being property, where we are not taxed on capital gains. Now, if you're a property trader buying and selling property, you are taxed on gains. But if you're a property investor and you hold it for long enough, you are not taxed. And we are one of the few countries in the world where that still exists, and I don't think it's going to last. I don't know any other product or service in New Zealand that happens in, apart from your home. But investment property and your home is not taxed if you hold them for long enough. And the government has started moving in on this space, but right now that's the case. And if you hold property long enough, you don't pay tax on the gains. If you hold your home for long enough, you don't pay tax on the gains. But it won't last, so you should get in quick, because when I first started investing, we didn't have a capital gains tax. You could sell it the next day and make a profit and it wasn't taxed. You could depreciate the building at 4% per annum, which meant tax credits every year. So we lived in property investing mecca then, but interest rates were 12%. And now they're 2-point-something% or 3-point-something%. So whilst we lost some things, we've gained others, and that's internationally competitive interest rates, whereas in the past we've been a very expensive place on the interest. And there's some other things you can do to be tax efficient. We still have depreciation on certain parts of the property. You can still transfer what's called capital dividends, ring fencing of losses. And this is where I'll beat up the media. When the government put what's called ring fencing of tax losses for property investors, and what this means is that you can't transfer tax losses on a property if you've got tax losses to your personal income. They stay with the property. And the initial media reporting of this made out like property investors were getting shot. Well, it's the opposite. Ring fencing of losses, which means that the losses stay with the property, means that when you are retired as a property investor, your profits from those properties at that time will have tax losses next to them, which means if you're getting $70,000 a year from your properties, instead of paying $20,000 a year in tax, you've got credits. So you're going to get $70,000 and you can spend $70,000. And in your retirement, that's when you need it. So ring fencing is a bit like KiwiSaver for property investors. And the misinformation that was out there on this topic was just unbelievable. But when you break it down, it's actually a very good thing for property investors, because Kiwis, property investors included, aren't great savers. So if you're spending all your cash flow as the property is going, and then you get to the point of retirement, you will have tax losses built up in those properties, which is great, because when you're living off the rent to the point that you don't have any debt, you'll have tax credits that you're going to basically effectively be spending. So there are other benefits. If you're an employee, as your portfolio gets larger, you can claim deductions. Property's a business, so it's no different to starting up a dairy or a cafe or a services business. Property is actually a business, and you get tax benefits in the business. And we need, again, like the broker, you need to have a good property accountant, not a bookkeeper, and our team will be able to help you get a referral for that. So tax is boring, but it's so important when it comes to property, because you can have huge changes in your cash flow just through good property accounting. And we've got expert companies that we refer you to that can help you with that. Okay, I've actually been on time. This is a miracle. David's just going to be blown away. So that's a bit of a quick one. We're going to be doing weekly webinars for a while now, until we're allowed to go back to the office. But even then, I don't think we're going to be flying around the country. For the last couple of years, we've been doing events in the room, and we'll probably still do those, but they'll once we go back to level 1. But we'll probably do them more infrequently and do more of these. So please give us your feedback, because as much as it's nice I love meeting clients. I love having a drink after we do in the room event. but we can actually reach people really quickly through webinars, and I think it's a fabulous medium. You can do live Q&As when someone else is answering them. I think it's a very powerful tool, but I would love your feedback. Now, the other thing I haven't talked about tonight, which I am going to talk about now, is we've got a whole bunch of free tools and resources that you can get off our website, get from our team, get from our business. Now, the first and main one of these, and I think we've done 50 investment capacity reports since lockdown came in. And these are a 6 or 7 page document that basically helps you understand your financial situation. It's a tool designed to show you where are you equity rich or cash poor. And this client is extremely cash rich, not equity poor, but they've got enough equity to buy $800,000 worth of property, but they've got enough income to service $4.4 million. Now, for some of you, that won't make sense. How does that work? Why can't they buy $4 million? Now, if they do it right, they could buy another $4 million worth of real estate, but they have to be very careful with what kind of property they buy. So this is actually the sort of thing, this is a harder one to fix than someone that was equity rich and cash poor. This customer is cash rich and equity poor, but they will effectively, they could spend all of their equity and have to wait for the market to grow before they could do anything else. And there are a few things about property when it comes to finance that it's so important to use a broker versus the banker, because the bankers don't tell you this. When you go and get a loan approval or apply for a loan with a bank, they look at 3 things: you and your character, your background, your history, your credit rating. So that's you. Then they look at your income, and that's global income. Income from dividends, income from your job, your business, but income from your rentals. And one of the things they don't tell you is that when they are assessing you for a loan, they scale your income back, your personal income, to 35% of what it actually is, and they only scale your rental income back to 75% of what it is. So they are telling you, without telling you, that they want your tenants more than they want you. And this is one of the reasons that people on modest incomes can end up with $4, $5, $6 million worth of real estate, because it's the rent that comes with the rental property that's the most important thing. LVRs, loan to value ratios. The other thing, we used to sell secondhand properties. We won't now. And we won't because of 2 reasons. The government are encouraging people to buy new versus old. New Zealand's housing stock in general is very old. And the government has said, right, people aren't providing for maintenance. So we're only going to lend 70% against that property, whereas if it's new, you can borrow 80%. So we've had a lot of changes in the last 10 years. And if you're first time up or new to this, or you're green to this, there's not much we don't know, and we eat, breathe, and sleep it. So these investment capacity reports will tell you a lot of the stuff. So please get one of these. They're free, and we will then book a time to have a chat to you, and our team will help you in level 3 lockdown. They can give you an investment capacity report, and then we've got another report which basically shows you a hypothetical situation of you if you bought 1, 2, or 3 properties. Please spend time on our website. We've got a huge amount of information on there. There's all the due diligence that you need on our deals to make an informed decision. And there's no such thing as a stupid question, so please make sure you do ask questions, and talk to your broker or a broker we refer you to, because at the moment they are still taking approval applications. The one stipulation that we've had at the moment is that if you want to get a pre-approval, which is you don't have a deal but you want finance approval, banks are not processing those right now. So you'll be put right to the back of the queue. If you go into what's called a conditional contract, you will get an approval. So the advice from our brokers is to put people into contracts that are conditional. So that means you have an out. You can cancel at any point in time. But in that environment, in that situation, the banks will process your application. So make sure our team can talk you through that more. And right now we can get property managers through, we can get building inspectors through, we can get valuers through. And if you live in that same city, I'm meeting a client next week at a property. We are one of the few industries that now can go back and do it. We are going to be practicing social distancing rules set out by the government. But we can. We're out backing. We're all so excited about next week about getting back to work. So yeah, I am going to have a quick pause and start looking at a couple of those questions. This is a miracle. My team's going to be amazed. I've never been on time before. So 8:04, look at that. So yeah, we're going to be online for the next 20 minutes for questions and answers. So shoot them through, and we'll state the question that someone's asked, and we'll explain the answer. So keep listening, and let me just have a quick catch up with David and the questions that he's had, and see what we've got. Oh, here's David's. David's deferred a question to me. Beautiful. We've had a question. You mentioned that quality developers won't drop prices because they're already high quality products. If that's the case, but existing homes could get cheaper, up to 10%, according to RNZ. Now, first up, I've got a friend, my cousin is a journalist. As much as I love journalists, the sensational headlines they use to get you to read and buy articles are scary. Journalists are not property experts, and it's a bit like the government. I've read 6% unemployment to 30% unemployment. Now that's a relatively wide spread. I have not read one economist who has given a statistic on house prices dropping with any substance behind it. And the property industry is made up of multiple classes: homes, investment properties, commercial, residential, industrial, and retail. And even homes, some developers who are that tight with their funding and all the rest of it might have to drop prices to get things to move. But that's the same in any industry. It's like cafes that fall over. Other cafes will stay open. And that comes back to how strong that business is. I mean, we spend a lot of time working out who are the builders, developers, vendors we want to deal with. And to my knowledge, not one of them has got any kind of headache, because building a house or apartment or a townhouse is not a 3-week exercise or a 4-week exercise. And we're not even into month 2 yet. So the reality is, unless a developer had serious problems before the COVID virus, typically most of them are building to order. And banks will extend them credit. Banks are dropping interest rates. Banks are giving interest rate holidays. These builders, developers, vendors will be taking advantage of that. And if you're a bank and you're a developer and you've got a customer who has got delays because of this, and the lending is sound, the last thing you want to do is take that loan over as a bank. Banks fire sell properties. Developer, builders, vendors sell them at retail. So there's going to be deals off this crisis, but there were deals on the market before this crisis. The thing that I say to most of our customers that ask this question is, most deals that we see don't make good investments. Even if they're discounted by 20%, doesn't make it a good investment. It's still got to stand up on its own 2 feet. But great question, because it's easy to get sucked into the journalistic views on life. But, you know, I was convinced that the All Blacks were going to win the last World Cup, and I gloated that to all of my English friends. We've got about 5 All Black clients. I watch it like one of those stalkers. I love rugby. Who saw England beating us coming? I didn't see that coming. Who saw South Africa winning the World Cup coming? I didn't see that coming. So, you know, the what we think and what we know and what happens are often 2 different things. So some people will sit on their hands waiting for these great deals of the century to come up. And in Queenstown, they will come up. But boy, I would be very careful buying them, because my first question, if I'm buying an investment property in Queenstown right now, is who's going to rent it? Because so many people there are actually unemployed. So as much of an attractive market it is, that's one to be very careful in. And I've been working and building and owning and selling and trading property in the Central Otago for 15 years. I've got property there now. I'm making some serious recommendations to our family about what we should be doing with some of those properties. Yeah, it's not. You can win massively in Queenstown, but you can lose very quickly there too. So it's very, just picking on that market as an example of where, I think there will be some drops. Airbnb market properties, some people have leveraged those to the hilt and their income has just stopped overnight. There will be keys handed back to banks on that property, that type of property. But in Christchurch, Auckland, Wellington and Hamilton, I don't think we're going to see a fire sale of residential property because there's demand exceeds supply. But great question. What else have we got here? Any cash flow positive coming to Auckland? No, Deneen, is nothing coming because it's already there. We have, I think, 3 cash flow positive properties in Auckland at the moment, maybe 4. So please talk to one of our team and they will show you those and take you through them. So yes, we do. We've got cash flow positive properties in Auckland, Hamilton, Wellington and Christchurch. Annual interest rates were the same in every year in cash flow projections. Look, we don't know where interest rates are going to be in 10, 7, 5, 3 years' time. We go above the lowest rate that's on market. I mean, Bank of China was offering a 2.89% rate the other day. I think we're working on 3.25%. So you've got to use, when you're forecasting, you've got to use something. We can't play God on everything. We think 3.25% is the right number right now to use in our cash flow projections. Internationally, we're still high. You know, there are banks around the world that charge 1%, less than 1%. There are banks around the world that charge you to put money in the bank. They'll pay you to put money in the bank for lending. So it's a weird world of interest rates, but I can't see any massive, and I talked to a lot of people in the finance industry about this. I can't see any move upward for some time. Other questions? Ben's asked if do I believe that the supply for residential housing in Auckland is oversupplied, and that post 6 month deferral, see a lot of property coming onto the. No, Ben, I don't. Auckland has a population that's growing at crazy rates. Now that should slow with the locking down of countries, but we don't know how many Kiwis are coming back to New Zealand. But secondly, let's look at the actual existing housing stock. The Auckland Unitary Plan was created to encourage developers to chop 2 houses up into 6, i.e. 2 old houses, build 6, 8, 10 new ones. And secondly, that is a brand new product. You take Te Atatu, well, we've got product now. It's called infill housing. And the Auckland Unitary Plan and some changes to the Resource Management Act allowed that to happen quickly. And these properties are new. Take greenfield subdivisions in South Auckland, out East Way. These are smaller bits of land, smaller houses. So the supply for property in Auckland is nowhere near oversupplied at this point in time, and I can't see it happening anytime soon. This COVID-19 could slow construction down. That could make the housing shortage worse. And secondly, if you measure infill housing and greenfield housing against existing housing, it's still a small percentage. We need more new housing because the old housing is mostly stuffed. If I look at investors that have held properties now for more than 15 years, most of our recommendations to them is to sell their old ones, sell them to owner-occupiers. I've got one client in Wellington. He's got 2 properties that he paid $200 and something thousand for. They're in a fabulous suburb, and they're nearly $1 million now, and he's holding on to them as rentals. So his return on cost is very high, but his return on capital is terrible. And when I explained that to him, he got it, and he said, yep, you're right, I need to sell these properties. Because he can replace those 2 properties for about 4. So you've got to look at different metrics. And in Auckland, there is still a massive shortage of new housing. You take Hobsonville Point, that used to be an airbase. Now it's a housing estate that's just growing and growing and growing and growing. So I don't know, Ben. Sorry, I think if we have huge unemployment, people still have to live somewhere, and we've got a government that's proactive, and I just can't see a massive crisis like we had in the global financial crisis. Someone's asked, given the recent earthquake in Christchurch, 9 years on now, that was 9 years ago, will that be a major deterrent to acquire property in Christchurch? What's your view on Christchurch versus Wellington, Auckland? Good question. I moved back to Christchurch a year ago. I lived in the North Island for 30 years. And in my opinion, the hottest market in the country is probably at the most risk of getting an earthquake, and it's called Wellington. I still own property there, and we can't make the numbers work there from a cash flow point of view because it's just gone up and up and up and up. But whether it's Auckland, Hamilton, Wellington or Christchurch, property is an insurable event, or earthquakes are an insurable event on property. So when the 2011 earthquake hit, the years after that, the 2, 3, 4 years straight after that, insurance was really hard to get. Now, Christchurch is easier to get than Wellington. So, earthquakes, volcanoes, tsunamis, they're all insurable events, and they're not reasons not to invest. So it's, the market's always changing and things adapt. The Christchurch is leading the country in foundation solutions, high rise and low rise. So if you look at if you haven't been here for a while, you should come down or up where we live. The Christchurch real estate market, we have not heard of any vacant properties in any of the subdivisions or the complexes that we've been involved in. So what we are seeing is a mass exodus from old properties into new. Same question, or same client is asking, why are most of our projects mainly townhouses and apartments? Great question, Andy. So if you look at return on cost, apartments and townhouses typically show a higher yield or a higher cash flow than house and land. And there's also an international movement away from bigger houses to smaller properties. So townhouses and apartments are going to become more of the norm. And take Christchurch, it's a house city. It's a garden city. People love their gardens here. But we're seeing millennials, 20-year-olds, 30-year-olds moving into townhouses and apartments in their droves. They want to be next to the city where all the action is. They want in the city. I saw the same thing in Wellington. When I first moved to Wellington, the CBD was dead on the weekends. No one lived there. Whereas now it's got traffic congestion like there's no tomorrow. So the reason that we're not promoting a lot of house and land packages at the moment is that the cash flow is not there with them. You get good growth, and it's a safe investment because if you have to sell it, you can sell it to an owner-occupier. But I see a massive shift towards townhouses and apartments, and we do still sell house and land packages. But the cash flow that we're getting from apartments to townhouses at the moment is just too strong. But good question, Andy. Gareth said, when you talk about cash flow, is this calculated with interest only or principal and interest? On all of our cash flows, we do both. We calculate it if you're paying the debt off or if you're not. And obviously, if you pay the debt off, you'll have more equity at the other end. But if you're paying principal, that's not a cost, that's paying down the debt. Every time you pay $1 of principal, you're increasing your equity by $1. So, whereas interest is an external cost. Max has asked, why are there so many properties without car parks? The Resource Management Act, Max, and it's called High Density and Medium Density Living. And there is a massive shift with councils around the country and around the world to get rid of cars out of cities, to encourage public transport and social transport like Uber and Lime scooters and all the rest of it. So when I first got into property 25 plus years ago, a developer couldn't build an apartment or a townhouse complex or a house without car parks. Now they're encouraging developers to build properties without car parks. someone said about this recent shock, earthquake in Christchurch. There was a mild shock. So Christchurch has been having aftershocks for a long time, but not just Christchurch. I mean, Wellington's had earthquakes. Wairarapa's had earthquakes. Earthquakes are up and down the country. So I don't think any. I mean, Canterbury's don't notice them anymore. So Amy's question about how long do you leave between trying to recycle deposits? Straight away, 6 months or longer? Great question, David. I remember these years when we were doing renovations in Wellington for 10 years. I just constantly renovated. And as soon as the property was finished, I went straight back to the bank and they said, sorry, but you've got to wait 6 months. And they wouldn't lend again for 6 months. So that's the rule of thumb, is 6 months. But I guess they're in an interesting climate right now because banks have been told to relax their LVR rules, their loan to value ratio rules. So I don't know, I haven't seen anyone test it. So, but work on 6 months because it's kind of the old rule of thumb. Let's have a look at some more of these questions. 20 answered questions. David, you've been busy tonight. Melissa said, don't you have to pay more tax when your property is positive geared? Yes, you do. But when you do your tax deductions, chattel and fit out depreciation, interest is tax deductible, rates insurance is tax deductible, then that can neutralise that. So, and when you have enough properties paying the positive cash flow, that's when we say, right, buy a capital growth property that might be negative in cash flow. So good question though. Andy's asked what's revolving credit. I assume everyone knows these things. Andy, revolving credit is like a big overdraft. It's where the bank will approve your facility, whether it's for 50,000 or 500,000, that you're not drawing down the loan, but you've got the ability to draw it down. So the more you draw, the bigger interest bill. So it's basically a great big overdraft. Someone's asked, how does one buy first investment property with 100% finance owning no other properties? You have to have a deposit, and you do have to put your cash into it. Some banks will let you put that on deposit, hold that as a security, and then lend you 100%. We've had customers that do that. So for your first one, you'll either have an 80% loan or a 90% loan if it's your home, or a 95% loan if it's your home. So when we talk about 100% finance, we are typically talking about somebody that's got an existing property. So if you're a first-time homeowner or investor, you do have to put cash in, but we have an environment where you can access KiwiSaver. You can use you can get a free check from the government, first-time buyer grant, banks that will lend up to 95%. So you can get into your first property with pretty much next to no deposit if you're buying it that way. And if you're an existing homeowner, then you can borrow 100% to buy a rental property using your home as collateral. Someone said, what will the LVR removal mean for investors? We don't really know. They won't. At the moment, they've got what's called LVR, loan to value ratio restrictions on second-hand property. I'm all for it because most second-hand property needs money spent on it in New Zealand because our housing stock's old. And from an investor, what it might allow is for investors to borrow, say, 80% on second-hand property. We just don't know yet. They haven't actually come out and declared anything more than that. Someone said, when Campbell said balancing cash rich and equity, does he mean the cash coming in from the rentals that needs to be balanced with the capital gains? Yes, sorry, it was a bit short on that. So what I'm saying is, if you go and buy a bunch of properties that are negative in cash flow and great capital growth locations, your personal income is topping them up. Whereas if you go and buy some properties that are positive in cash flow and less solid capital growth locations, you've got net cash flow positive. So what I'm saying is do those before you buy your capital growth properties. Kevin's asked, how long do you have to hold a property to avoid capital gains tax? It's 5 years, Kevin. It used to be 2, but they've increased it to 5. I think homes are 2. You can own your home for 2. You have to hold a home for 2 years, but don't quote me on that. But investment property is 5. What does rent need to pay for in order for rental to be cash flow positive apart from interest? Good question. Depending on whether you're managing it yourself, it could be a property manager, but rates, insurance, and interest are your typical main expenses to be a property investor. In fact, I was going to do a single property cash flow today, and I didn't do it. So I'll make sure I do that for the next one of these. But a standard property cash flow is rent less interest, which is generally your biggest expense, rates and insurance, body corporate fees, maintenance if there's any. And that's one of the other reasons why new makes so much sense at the moment, because you don't typically have maintenance costs because the property's new and it comes with warranties. Cool, good question. Andy's asked, why your scenario is only based on interest only? No, we do both, Andy. Why don't you pay off the principal? If you've got spare cash flow, we say pay off the principal. But if you're going to be going again and buying another property, we'd rather you have that principal cash to use for a deposit. Now, you can't live off interest only forever. At some point, you've got to pay the debt back. But capital growth typically, because if you're paying the interest only and the debt stays the same and you're getting capital growth, that's how you're growing equity. So if you've got the spare cash flow, yes, pay it off, because you can also redraw it. But if you're borrowing at 80% and you're getting capital growth, most investors are better off to go into an interest-only loan in general. Someone said here that banks only provide interest-only loans for 3 years. That's not true. It's a negotiation with the bank, and a lot of investors will get up to 5 to 7 years with one bank. They'll refinance to a new bank and they'll get another 5 to 7 years. I saw a client the other day. They've been interest only for 20 years on one loan. So, yeah, there's no rules around that. So it depends on the bank. Andy's asked, do we only provide service for the properties you are listing or on the market? Well, we've got a bunch of free services, Andy, and the properties that we've got on our website are properties that we've listed. So, yeah, I mean, if you want cash flows done for second-hand properties, you can download one of our spreadsheets and you can do it yourself. Where are we currently on the property clock? Well, every location is different, and someone's asked where we are on the property clock. Well, you know, and every product's different. Infill housing at Auckland, in my opinion, is at 6 o'clock. Herne Bay villas, I think, are at 11 o'clock, 12 o'clock. I don't know how much higher they can go. So every location is different and every product type's different. Someone's asked, should we expect a 10 to 20% property price drop? I don't think so. I don't know, but I don't think so. Do we purchase properties with the aim of recycling initial deposits to purchase another property? Yes, we do. But at the same time, saving up for deposits is good, but the property will typically grow in value quicker than you can save on most incomes. Great questions tonight. Will banks lend? Donna's asked, will banks lend on just rental income? No, they'll also lend on dividends, and they'll lend on personal income. And it's not that they'll lend 75% of your income. They use 75% of your rental income and say 35% of your personal income to calculate what they'll lend you. So there's a bit more math to it, but again, our team can show you how that works. Another good question. On average, how long does it take for your clients to go from putting a deposit down on a property with a developer and actually having people living in that property? That's a great question. If it's a high-rise apartment, 2 years. If it's a house and land package, 9 months, maybe 12. If it's a multi-unit complex, somewhere between 12 months and 24 months. But the good news is they can't change the price on you. You know, you're locking in your purchase price. Kieran's asked, do we recommend starting a company purchase rental property rather than buying a personal name? Depending on your situation, Kieran, it's could be one or the other. We don't give asset planning advice. We refer you to a good accountant. Most people, most investors will still put a property in what's called an LTC, which is a look-through company. There are still some benefits for owning your rentals in a look-through company. Some people will put them in a trust. Some people put them in their personal name. Typically not recommended to put in your personal name because you are risking your properties based on your own personal risk at that point. All right, another question. What do I think about apartments on leasehold land? I don't like them because leasehold land means that you're paying rent on the land and you own the apartment. So, yeah, I'm not a big fan, Carolyn. Some people do. I mean, take Central Auckland to the Viaduct. I mean, there's some stunning apartments in there, and the leasehold rates have been set for 100 years, but you're not going to get the same sort of capital growth if you own the land. Andy's asked, when is a good time to invest? I say now. I always think it's now. There's never a bad time to invest. Probably is a long-term game. You've got to start at some point. And to me, the numbers dictate whether you should or shouldn't buy. Yes, you want to read the cycle, read the market, where's the timing at, etc. But there's no, and it's not an overnight thing. I mean, investing can take 6 weeks. So it's, you know, it's a long-term game and there's a lot to do, but it can change your life financially. Property's been extremely good for us. And that's not luck, that's just hard work and timing and knowledge and a lot of things. So it's, yeah, there's a lot to learn. It'd be like learning how to fly an aeroplane. It doesn't happen overnight. I think I've got most of those questions. But we'll be on here for a bit longer, and if you've got anything else, send them through. Please talk to one of our team as well. We have a great bunch of people around the country that will help you. And yeah, keep an eye on your inboxes for our next session. Send feedback in terms of what else you want to know about. You know, we've been around this business for a while in terms of property, and I think we know what we're talking about. So yeah, keep the questions coming. This is great chats tonight in terms of questions.